to pay the depositors. And once you do that, the whole thing gets marked to market. So it's just it's a pyramid that implodes. So you had a lot of phony accounting to begin with, but you're exactly right. In a liquidity crisis, you don't have the luxury of sitting on the hold to maturity account. You have to sell it to get cash to pay the depositors. Silicon Valley Bank, 97% of their assets were not FDIC insured, or they were beyond the limits. The insurance limit is $250,000 account per account. I'm sorry, Cisco had, I think, $3 billion. There were crypto exchanges. I'm not dinging crypto, but the crypto exchanges, they get dollars. They were on deposit at Silicon Valley Bank, and fives and tens of billions. There were also who knows how many startups, and they might have a $5 million account where they had done like an A round or a venture round or whatever. And I call it crybaby weekend. That weekend between March 9th and March 11th, 2023. But here's what happened. There was a run on the bank. As I say, almost all the deposits were uninsured. And Goldman Sachs came up with a salvage plan. Basically, they said, okay, we're going to take the hit, take the hit on the books, but we're going to issue an equivalent amount of new stock, to an attractive price. That'll fill the hole on the balance sheet. We'll stabilize this whole thing and we'll move forward. The problem was, there's always enough stupidity to go around, but Silicon Valley Bank they were slow to sign the NDAs for the potential investors that Goldman had lined up. So the investors, banks and others, General Atlantic was, them, they were in the lead. They said, we can't do the due diligence. And they backed away. The stock price crashed. And then Goldman walked away from the deal, rightly so, because the whole thing had imploded. But the government did two things. One of them was exactly what you described, James, which is just to set the frame. Friday night, when that bank was shut down by the FDIC, they issued a press release. And what they said, and this is fascinating, this goes back to the G20 meeting in Brisbane, Australia in 2014. So what was going on in Brisbane? So we were coming out of the global financial crisis, 2008, 2009. Growth was slow, but it was back. But there was enormous popular unrest. People like, hey, Jamie Dimon, all these guys, they kept their jobs. They got their bonuses. They're making billions. There was no punishment, no accountability. But meanwhile, we lost our business and we're unemployed, et cetera, et cetera. And the political leaders took note and they said, okay, from now on, no more bailouts. The new policy is going to be bail-in. And what does bail-in mean? It means that when an institution fails, you identify the hole in the balance sheet. Like, okay, you're insolvent. You have negative net worth. How do we fill that hole? First hit is equity. Equity goes to zero. Done. You're done. Next hit are depositors, but next hit are creditors, lenders, which can be secured or not secured. And that makes a difference. But you're going to take a haircut. Is it 20%, 30%? Don't know, but you're going to take a haircut on your bonds. And then, or we'll convert you to equity, which is the typical restructuring. And the third category were depositors. They say we're going to guarantee the deposit, $250,000 in the FDIC. It's 100,000 euros in the Eurozone, but that's it. And if you have a deposit over and above that, you're getting a due bill, you're getting a certificate, and might be worth something, but we'll get back to you. So equity gets wiped out, bondholders take a haircut, and depositors get the insured amount, but not more, and they get a chit for the difference, and we'll get back to you. And that's what the FDIC did in 2023. They actually lived up to the bail-in rules of Brisbane from 2014. It was the first time that there had been a real-world case of that agreement. It lasted 24 hours. And then you had what I call crybaby weekend, where Bill Ackman and all these guys, they're running to the White House and they're saying, "Oh, you don't understand. All these startups, they're losing their working capital. They're not going to be able to pay the rent. They're going to have to lay everybody off. There's going to be a recession in Silicon Valley, et cetera, et cetera." Leave aside the fact that 90% of those firms fail anyway. I mean, they were kind of ignoring that, but they were like, "Yeah, we got to save." And the White House heard them. And then so Sunday night at 6:00, before the markets opened the next day, of course, and exactly 48 hours after the first thing, they said, "Just kidding. Deposits are insured in unlimited. Every deposit is insured. Doesn't matter. $3 billion Cisco, boom, you're covered." And to your point, every bank in the system, every member bank of the Federal Reserve System was given a facility. you could deliver your bonds, your treasury bonds to the Fed basically, and you would get back cash equal to the par value of the bonds, even if they were underwater. So the bonds were 70, but you're getting 100. So 1 year loan, practically zero interest. But with a wink and a nod, it was like, hey, if the year's up, we'll extend it another year. That didn't actually happen because things had calmed down by then. So, and I looked at it. I understood all of it. I followed the meeting in Brisbane for that matter. But I thought, okay, they just guaranteed every deposit in the system, regardless of insurance limits. And they just guaranteed every bond in the system at par, no matter how underwater it was. I thought, at the time, I had a 15-year-old car with 225,000 miles on it. And I thought, will you give me the market value, what I paid for my car? I'll drop off the keys. Just give me the original value. But